far. We'll be starting soon, just waiting a couple minutes so everyone can join us this morning.
Looks like we have a full house this morning.
Yeah, it's very exciting.
Woo!
Wait a couple more minutes just to make sure everyone has had a chance to join. Alicia, thank you. We're excited to have you here too. All right, all these East Coasters. I guess it's not as early for as I thought it was.
Yeah, feel free to put your geographic location. Yeah, so
Yeah, I hope
nice to see
everyone
everybody.
has lunch and ready to enjoy a fun webinar. So we'll wait one more minute. Wow, Israel, I love it.
Hello.
We'll wait about 30 more seconds and then we'll get started. All right. Shahar, are you ready?
Always.
Welcome, everyone, and thank you so much for joining our webinar today. My name is Amanda Brockmuller. I'm a senior accounting expert here at Formations, and I'll be your moderator and co-host today. I'm joined by Shahar Plinner, Formation CEO and co-founder. We want to thank everyone who registered, and we're excited to dive into some excellent content today. But first, we want to review a few housekeeping notes. We will be recording today's webinar, and we'll send out the recording and the webinar's ebook afterwards to the email you used to register. Additionally, we encourage participation throughout the webinar and look forward to answering questions through the Q&A module. We will have a few individuals monitor the Q&A. Dee and Joey, thank you so much, to help address incoming questions with our speakers. In addition, we are offering complimentary consultations to all of our webinar registrants. We'll drop a link in the chat where you can schedule your meeting. And if at any point in the webinar you want to meet with an expert, the team at Formations will be happy to help. At the last part of the presentation, there will also be a QR code that you can scan on your screen, allowing you to schedule a consultation with one of our experts. Before we jump in, I'd like to introduce Shahar Plinner. Shahar is a tax and accounting expert with over 20 years of experience in the field. You don't look a day over 30, so you wouldn't be able to tell that it's been 20 years.
I started when I was 8.
He is an entrepreneur and known as the tax guru on the West Coast. 3 years ago, he founded Formations, a predictive tax management solution for self-employed to gain visibility and control, make better business decisions, and predictably save on taxes year over year. Today, we'll review the top traps that self-employed individuals fall into and how you can avoid them and achieve success. Let's conquer the 7 deadly sins once and for all, get stronger, and make smarter decisions. We've got a lot to cover, so without further ado, Shahar, take it away.
Hey, appreciate it, Amanda. Thank you so much. It's such a great joy to join the webinar, and also with you again. I love your energy and knowledge. I know that I see on the chat that some people have some hearing issues, so I think maybe it's a personal. I think everybody else can hear us loud and clear. This is an interesting concept that we are delivering this morning. As my background is mainly around taxes, and we'll share a little bit more about what Formations is doing in the world of self-employed and how we create the first to market tax management solution that helps self-employed to manage their what we call the largest unmanaged expense, taxes, the amount of money that you spend the most on an annual basis as an individual. It's time to take in control and make sure that you save on taxes and keep more of your hard-earned money in your pocket. But the idea of today's discussion is more to bring an awareness. Again, we as a tax consultant, we people that understand the tax system and finances, we want to bring awareness because that awareness brings some consideration. It actually makes your mind start working. What else is possible, because we as self-employed, including myself, always live in this FOMO. What are we missing out? Why do I feel that I'm overpaying on taxes? Why other people are doing better, than me financially? And we know that there is, relationship between people and money. Sometimes that relationship is not healthy. But again, if you're aware that there are some things that you can do, or what we're telling everybody, what else is possible, because always there's something else possible financially to improve your well-being, please consider. And I think the most important discussion that we're having with self-employed is the action. Lean in, take action, because when you take action, there's an impact, and the impact is very, very clear financially when you take steps to make yourself more financial and tax savvy. So I think that the discussion today, again, the 7 deadly sins, will enlighten some of those area. We'll try to keep it, in as a simple language, because we know that speaking financial sometimes is speaking kind of a foreign language. Before we start, Amanda, any wisdom, any words of wisdom to our audience?
Yeah, I really like this topic. It's a little bit more theoretical than what we do in our day-to-day, diving into the numbers, but it's kind of fun to take a more higher level approach to some of the common pitfalls that we see. And it really helps start that conversation, I think, because I know I personally can relate to a lot of these. So it's nice to know I'm not alone, no shame or blame here, but it is a great way to be a little bit more cognizant of some things that, can be a pitfall and start that conversation.
Yeah, and again, I think that the common thread is that we don't need to be experts in everything. We need to be dangerous enough to understand. We need to surround ourselves with some great, what you call the dream team, the advisors. Again, your knowledge is more around accounting. It's not my sweet spot. Again, you're educating me a lot. I'm more on the tax side, and once we, decided to go a direction and we paved the way, I'm also a student of the journey. And this is kind of what we share with the audience today. Be open-minded, learn new concept of finance, accounting, tax, retirement, real estate, insurance, educate yourself. Again, you don't need to be the expert, but know enough to make a smart financial decision. Are we good to go? All right. So again, the chat is for you. Lean in, ask question. First deadly sin, don't confuse income and profit. When we refer to income and profit, while the two might sound synonymous, income is the total amount of money that you're earning in your business, otherwise known as gross revenue. Again, it's the commission, it's the top line, it's when you invoice your customer, this is what you actually want to get, the gross amount. We'll speak a little bit more about, the fact that we self-employed, sometimes sell ourselves short, but this is the amount that you believe you are worth to earn. And this is kind of the top line, the gross revenue, the income, which is very different from the profit, which is the amount of money earned after deductions, after expenses incurred, to make the income. So profit can also be referred to as your net income. And the net income is important for us to understand, because usually this is the amount that will be subject to taxes. When you gross income, when you make your commission, when you invoice your customer and the money first hit the bank, this is where the fun began. You can have deduction and expenses and benefits, and you can have a write-offs. We'll speak a little bit more about what is kind of smart deductions and how to be more efficient. But once you're done deducting all of those expenses, this is where you see the net income. But I think what's important to mention is that income and profit not always going kind of at the same direction. And what we want to make sure is as you make more income, you actually save more money. So the expenses are not growing at the same, rate. So for example, if you had a great month of revenue and overall kind of you're projecting or you're actually collecting, 5% more in sales from last month, great, woohoo, kudos. We always want to kind of get our business in a better position. But again, wait, it's also important, to understand your expenses. And if you increase your expenses 10%, did you really make more money? So if I made more, but actually my expenses grow even in a higher pace, this is a healthy business. So before you celebrate, too soon, make sure to look at your financials as a whole. It's tempting to focus on the sales exclusively, but in order for you to profit, your profit to grow, expenses need to be kind of consistent or even decrease. And we see, when people are making more money, there is some magical kind of phenomena. One, there is a really need to expense more. There is a desire to expense more. But on the other end, when we look back and kind of we are review our business operation, there's so many things that we're building as, our branding and our IP that allow us actually to get into those higher projects without the need to increase significant amount of expenses. So again, one way to achieve higher profit is by spending less money to make those sales. You can actually get into the top dollar amount sometimes by just increasing price, or very common in the last few years is the value add pricing. We're moving out of an hourly rate into like a project base, and make sure that you know how to price your project correctly. Again, we already mentioned we're all selling ourselves short, and make sure that this is basically what drive kind of the top line. But expenses wise, as I mentioned, you build your reputation, business strategy, you improve ideally kind of your business operation, allow you to spend less, for instance, on advertising, and basically push, your expenses a little bit lower, increase margins. As your network and customer loyalty grows, the size of your transaction also grow. We see it in real estate when people basically get a bit more confident, and from selling properties of $500,000, moving into the $750,000, into the $1 million, into the 1.5, and then the commission grows. And sometimes the activity that you need to maintain that book of business, expenses are not growing at the same rate. So again, therefore, profit is a way more accurate measure of financial success than income, as it takes in account your expenses. So we definitely, again, want people to focus on the top line. It's super important to bring more and more money, but it's really, really important also to focus on the bottom line to make sure that your business is really healthy and you have healthy margins. All right, scene number 2. Prioritizing short-term gains over long-term success. Entrepreneur, the cookie monster. We don't want to delay gratification. Everything is now and immediate, but sometimes slow and steady wins the race. So again, it's not for everyone. And sometimes, your current business goal is not growing. Sometimes business owners want to, maintain, but some of us, yes, want to continue and expand their business, and grow can be expensive for a business, especially in the short term. You need to put some either new processes, procedures. You may need a short-term hire, maybe a full-time hire. There is some cost that's related to expanding kind of your business operation. So if you decided you want to grow your business, it's tempting to think that spending more overall will earn you more. So again, we can argue about it, and it's important to slow down and analyze which expenses are worth investing in. Once you refine the expenses, focus on the categories that will have the highest impact on your business growth. For example, in order to optimize your business strategy, it might be more beneficial to invest in continuous education, seminar, training, get knowledge, than just spending more money on social media, on some other short-term campaigns. So we see that sometimes in business that you are tempting to get into a short-term gain project that maybe yield more money for us, but it's a slightly distraction of what the core business. And then for the long term, it actually will slow us down. So every time we're thinking about the next customer in or the next segment of customers that we want to approach, we need to kind of process and realize if this is something that will build us for the short term, or actually it will gain us, more momentum long term and keep us in business. So I think that, this is kind of it's a simple equation that everybody is familiar. When we basically run our revenue, as we spoke, the top line, the gross revenue, minus expenses, minus our write-off, minus, the things that we can expense to keep the lights on, and then we're left with profit. So this equation showing here is the default, equation most business owners are familiar with. And when we speak about old way of running your business versus the modern, when we try to put percentage against it, the traditional way was, I have about 1/3 of expenses, 1/3 of taxes, and then I left with 1/3 of profit. So I want to break this, equation today. And when you earn money, you spend money, and then you get to keep whatever left over. And I think that, we maybe want to reimagine, that formula, because if you don't take time to assess which area of your business you should invest in, the expenses part of the equation, it can get really, really big. And it's easy for you to get, bigger and bigger in expenses, and therefore no profit left. What happened if you have to think about the formula a little bit different? What happened if, if you think about the revenue and then what I can take to myself and leave the business expenses last? This is what actually, will help me to keep the lights on. So in formations, we want to change the mindset for the self-employed. And this pitfall can be avoided using what we call the profit first model. So instead of leaving yourself with whatever is left over, decided what you want to pay yourself first. So I'm making good enough money. I'm making 200, 300, maybe sometimes $400,000 a year. And I want to take home, 40%, 50%. I want to make sure that, the business is actually, what generate the well-being of myself and my family. So then I've decided what I'm taking first, and then what left is what actually I'm keeping, to run the business. So if you set yourself, reasonable compensation, the W-2, and we can speak a little bit more why self-employed need to be an S-corp and take themselves, a reasonable compensation W-2, but you take this compensation and the benefit, and then you decide what do you want to distribute yourself, on a monthly basis. And then whatever is left over, this is what actually you spend, as your business expenses. Just a little bit different mindset can yield a huge success. And then when we think about the ratio, now instead of 1/3 expenses, 1/3 going to taxes, and then I'm taking home 1/3, 33% of my, gross revenue, we see customers basically using a very smart and efficient tax system, paying no more than 20% in tax, and then take home, 40 or 50%, of the profits, allow us basically to spend way less on the business. So the model basically, if you optimize it, we more see it kind of, 20% around expenses, 20% around taxes, 60% take-home money, which is double, than just the regular formula. And this model guides you to focus on your business goal and be more intentional with the expenses that you invest to grow your business. I love the toothpaste, kind of metaphor, and it's great when every time kind of I'm in my day-to-day in my life, and again, brushing your teeth on a daily basis, maybe twice, 3 times a day. It's coming back when you just think about it. But the amount of toothpaste in the tube represents your bank account. So when you open a brand new tube of toothpaste, the tube is full, and you tend to be more liberal with the amount that you apply on your toothbrush, and it's like, it's very wealthy kind of experience. However, when the toothpaste is almost gone, it's amazing how we kind of, in a creative way, we can squeeze just a bit more out. The profit first model gives you visibility into the amount of toothpaste in the tube. Since you know how much is allocated to spend on expenses, you're able to budget your funds way more efficiently. So I think that with the slow and steady mindset, you can smartly grow your business without sacrificing your profit. And I think this is kind of also the overall, I think, mindset today, which is, closing Q2 of 2023, heading in H2, second half part of 2023. We're not sacrificing, or we are, trying not to sacrifice growth at all means. We're trying to be way more profitable, create more cushion for cash. We know that this is kind of not an easy financial times for most of us. Again, we're dealing with thousands of customers, and I can tell you that many are struggling at the moment. And even if business is really great, there is some cloudiness around the unknown and confusion. So again, slow down, get into the rhythm to make sure that you take care of you first, is super important. Amanda.
So you're saying if I get a business car, I shouldn't get the biggest, fancy, flashiest one? Is that what you were trying to say with that last?
I'm saying that, even if you want this big, flashy car, it's fine. It's just the way to how you finance it. You can have a discussion about finance. I would put less cash, more, finance at the moment, and we can speak more about debt and smart debt. And you can get, instead of a car loan, you can get a home equity line of credit. Or again, there is some variety of ways of how to navigate financials decisions. This is topic that I love the most. Again, I've been in consulting, as you mentioned, almost 20 years now, and you always sell yourself short. Why?
Yeah, so deadly sin number 3, selling yourself short. Just because you're a small business doesn't mean that you need to think small. But we know owning a business can be really scary. And often small business owners will fall into that trap of thinking really short term or too small, and they'll just prioritize those day-to-day operations, which makes it really easy to overlook that big picture. And when you overlook the big picture, it makes it more tempting to make reactive and impulsive decisions. So again, as you were mentioning, Shahar, take a step back, give yourself that time to assess the situation and allow yourself to get creative. You can take a more strategic view when challenges arise and start recognizing long-term opportunities. So for example, utilizing retirement contributions not only provides you that extra expense and lowers your taxable income, so it provides tax savings today, but it really also sets you up to protect your future. It builds that nice nest egg. Other ways to build a successful future that start now but are good and beneficial for the future are investing in new tools and software, reviewing your business structure, and becoming more financially literate.
And think about, selling yourself short. So, when we build our consulting business, I think it was back in 2000, maybe 13 or 14, the traditional accounting industry was always kind of an hourly rate, and it's always hard kind of, to put kind of an hourly rate and make it precisely kind of the value that you believe that you are creating for your customers. And I want to tell you that, you're creating value to your customer more than what you even believe. And when we start experimenting with pricing, at the beginning it was, let's do like flat monthly fee. It will be easier for customer to engage if they're not exposed into an hourly rate. And then we moved it into pay us half upfront, because we want to improve our cash flow. And there's always a concern about changing pricing, and there'll be a pushback by customers. And then, we saw that we can charge, 50% upfront, and it's a win-win situation. The customer loved the fact that they know, that they have this fee that they can project and put into part of the budget. And then, when times were a little bit kind of even tougher, we moved into a full prepay. And there was always a fear, kind of doing those experiments. And if you build a really successful and trust environment with your customers, they will understand and they will support and they will be, champions of those decisions. But again, taking care of yourself, I think, will be a theme of that morning presentation.
Yeah, I think in accounting, the common joke is we're always driving in the rear view mirror. We're always looking back at what happened before, but I think it's really powerful to use that historical information to project for the future and think for the, plan for the future, make decisions today that are really going to benefit you, 3 years from now, 5 years from now. I think that it's easy to get lost in the day-to-day stuff, but it's important to project out and manifest that business growth. So deadly sin number 4 is focusing on metrics that don't matter. So looking at segmented metrics aren't always helpful for small businesses. Make sure you ask yourself, what financial information is important for me to make the best decisions for my business? Do I have the right systems in place to effectively assess and measure these metrics, these goals? So for example, as a small business, as Shahar mentioned, a third often of your gross revenue goes to taxes. So it wouldn't make sense to take your business's profit at face value without acknowledging that you're going to be paying some taxes on it. And so at Formations, our goal, we designed the Formations platform to really make it easier for you to focus on the numbers at a glance that really matter. So on your dashboard, on the Formations dashboard, we provide highlighted metrics that are important for the business. So you're able to quickly review your total income, your expenses, what you spent so far on payroll, which as an S Corp is required to be compliant. And it also tracks your tax liability, which I know is really important. We're in the business of predictive tax solutions. So knowing what you're going to owe in taxes is really important to a lot of our customers. So having that visible has been really beneficial. This data is updated regularly, so you can always have a pulse on your business and not get lost in the transaction weeds. So, our goal is that you are not doing your bookkeeping, you are reviewing it at a higher level and then can spend that time that you would have spent tracking and get that visibility into your business and make decisions that you need to make as a business owner. So on the dashboard, we have those boxes, the income expenses that really at a glance make it easy to kind of see where you are on any given day.
I think that what we're saying is that, visibility creating ability. At the end of the day, the most of the tax and accounting world, including the IRS, is geared towards corporations. And when we're dealing with corporations, corporations has both visibility and ability. They can hire, controllers, and they can hire CFOs, and they can hire business consultants. And the role of those business consultants is basically take all of the data and make it visible to the decision makers, to the CEO, to the CRO, to the COO, around areas of the business that are growing really well, and we should keep increasing and investing, or maybe areas that are not functioning, to the extent. And unfortunately, again, we self-employed, the largest segment of the workforce, being overlooked and underserved, and have very little visibility to our financials. And I think in 2023, when cloud accounting and cloud computing and overall, again, through technology, we can get access to those resources or to the financial sources, we should thrive to get a full picture of our business. Again, maybe not on a daily basis, maybe it's too much, maybe not on a weekly basis, but at least a couple of times a month, so we can actually, feel the pulse of the business and make smart financial decision live, and not usually how we treating, our taxes, going to the CPA, in March of the following year. We already missed a year of opportunity, and then we are, asking for the CPA to be a magician, do surgeries, help us to reduce the tax liability, which sometimes it's really, really hard because we are missing out.
Yeah, I think a conversation I have with a lot of our customers too, kind of blending both the focusing on metrics that don't matter and thinking small, is getting really caught up on transaction categories. So, is this a business meal? Is this advertising? Is this? And, from my experience in corporate accounting, I can tell you the C-levels are not looking at that granular level of detail. And so it's funny because we have built our chart of accounts to really mimic the tax form. And there's a sweet spot though, where you want enough visibility and detail into your transactions that you know where your money is going, but you don't need a 50 account chart of accounts. You don't need stuff broken out so granularly, unless that's really what you want to focus on, is us, if you see how much you spend on hotels really going to make you change which hotels you go to, rather than seeing travel as a whole, then maybe that's something you want to measure in your business. Otherwise, just having a general travel category is enough for people to make those types of decisions.
Yep. Yeah, $20 a day Starbucks can be very expensive on an annual basis, So, yeah. All right, let me see number 5, not letting your money make you money. The next 2, 5 and 6, will be how to use some external instruments in order to improve your overall business or financial well-being. So again, your business bank account, it's not your piggy bank. And we learn it from, last couple of months, seeing some meltdown of the banking industry. So while most of our money is protected, and even if there's a rundown, usually the money is protected. Going above and beyond that is that keeping too much cash in your checking account is just actually not doing anything for you. It's a disservice for your business. And for sure, as you may have noticed, the cost of everything increased in the last couple of years. So, we refer to be inflation. So while it may be tempting to see your bank balance grow and grow, this is the life philosophy of my mother-in-law. She's just, when she see more money in the bank, she feel more comfortable, but she's on retirement. So she's in a different kind of, state of mind at the moment. But if you're not letting your money earn interest or working for you, the value of your dollar is actually, decreasing. This is, simple finance, or economic phenomena. We recommend business owners to keep about 3 months worth of expenses in your account. Anything over that should be invested back in the business for areas that, will yield short-term returns. You can invest in retirement, solo 401ks or Roth IRA or post-money accounts, defined benefit, cash balance, or you can actually take the money out and make sure that you have some passive income around rental properties, something that in the nature of investing something today will give you some passive income, and then the money is actually working for you and not you working, for your money. But again, there's some very healthy metrics, and every business is a little bit different. Again, once you take, for instance, your tax return, you can see how much expenses in general, you expense on an annual basis, divided by 12, multiplied by 3, get this 3 months kind of magic number, keep that in the business account, just to make sure you keep the lights on if something happens with revenue in the next couple of months, and then all the rest of the money should be out working for you in the personal level. And it doesn't need to be risky, it has to be the right way for you. There's a spectrum of investment, and some of them can be super solid and overall increasing your financial well-being. And again, part of what we were telling everybody, use the dream team, use your network to have a financial planner, financial advisor, a wealth manager, someone that will help you to make those decisions, both for investment and for more long-term retirement, to let you know, hey, if I want to retire age 60, 65, 45, if I'm fortunate, how much money do I need to basically live very comfortably? So one thing is to take the money out of the business to make sure that the money is working for you. And then the other side of the equation is sin number 6, avoiding smart debt. So business owners and debt should be great friends. Debt is a vehicle that is not necessarily scary. It's actually it's a vehicle that is pretty solid, and if you use it in a smart way, it can help you in different ways of the business. So leverage debt can be a super powerful tool to help grow your business. Debt comes in forms of short-term debt. Again, that you're paying on like credit card, or I don't know if you guys are doing factoring or something that you borrow money for the short term or long term. Again, line of credits. We know long-term debt from our personal life. It's kind of in the nature of mortgages, small business loan. During COVID, which seems ages ago, government came with the PPP and the SBA loans, the EIDL, allowing business owners to get access to smart debt, lower interest rate, great payment terms, and overall to build cushion of cash for the business. And again, just like in your personal financial, it's important to use debt responsibly. Charging up your credit card bill beyond what can be responsibly pay off each billing cycle can potentially turn into an interest generating monster, and we know that sometimes as young adults, we get credit cards, and sometimes the credit card management go beyond our means, and it's really hard, to manage back just because those interest rates are monsters, 16, 20%. It's really hard to follow up on. So if cash gets tight, and sometimes again cash gets tight, it's wise to focus on paying off again higher interest rate with some cheaper debt, and again you can evaluate different debt mechanism and instrument. Younger generation kind of can get access, sometimes to student loans or different plans for short-term debt. We just need to make sure that we understand what is the debt agreement, what's the payment terms, what's the interest rate. And I think one of the benefits of using debt efficiently is that the interest that you paid on the loan as a business owner, if you take the right business loan, can be deducted. So, I'm paying 8% interest, while it's not, the free money that we got used to a couple of years ago. But if I'm, again, in the 20% or in the 30% tax bracket, I'm getting a write-off on the top of the amount. So instead of paying 8%, it's more like 6, so it's more like 5.5. And it's pretty reasonable for us. So it's okay to take some calculated risk as a business owner. We're always taking some calculated risk at the front of the house. We are creative with our customers. We are basically, being brave and bold and lean around, getting the next customer. Sometimes we are too conservative on our back office. And the lesson here is that we need to explore any opportunity to keep the business healthy and alive.
So yeah, that brings us to our final sin today, deadly sin number 7, ignoring your business's seasonality. The longer you're in business, the more financial trends you start to observe. So for example, let's think about real estate. We know that less people tend to move in around the holidays, and more people like to move in summertime when the weather's nice, before the kids start school. So keeping in mind these types of cycles in your business is key to successful financial management. It's important to plan for the ebbs and flows of your business to help keep your business's financials healthy. Some other examples of ignoring your seasonality would be that it probably wouldn't be the most effective, knowing the seasonality of real estate. It's probably not the most effective use of your cash to spend your highest advertising dollars during the months when historically sales have been the lowest. Another example we see with S corporation owners, which it's a requirement to be compliant that you run your reasonable compensation payroll, is not running it all year, and that goes back to the profit first, not planning on paying yourself first, and then at the end of the year having to do a year's worth of reasonable compensation catch up when sales can be slower. So it's really important to plan for these trends. It just it's ease of mind, and also just key to being financially successful. So we, knowing that how important this is for business owners, on our formations platform, we make it easy to visualize these trends. Our dashboard includes your profit and loss statement in a graph format, so you can visualize which months were the most profitable. This is just kind of an example of what you would see on your formations dashboard, where the graph is interactive, so you can look at just actual income, and that's represented here by the purple bars, so you can see which months are the highest revenue earning. The yellow is the expenses. You can see when you're spending the most money. You can see the ebb and flow of your business, and the longer that the more historical information we have, you're even able to kind of compare that to prior years to see, how you're doing this year compared to last year. And it's that easy to visualize, quick snapshot where you can come in and you don't have to be the accountant, you don't have to crunch the numbers. It's all there for you in consistently updated with actual data from the transactions that occur in your bank accounts and your credit card accounts.
And I think it's important, when we always referring self-employed as professionals, we are comparing them to athletes, and because we have the same kind of, we own our own destiny, we need to perform, we need to restore, we need to train. And I think that, athletes in their life, it's pretty obvious that they first need to train. And sometimes training takes, months or years for a short, performance. But then when they perform, they put the best version of themselves. And then what they do after they perform, they restore. They basically build the muscle back. They bring the energy back to the body. They build back kind of, the body readiness to train again. And I think we as self-employed, we perform, and even more. and then we may slow down to do some training so we can be better to perform. And then, we just forget sometimes to stop and restore and get basically, the energy back and our soul back. And I think knowing your business seasonality, it's great because then you can actually, restore at times that the business is really slowing down. And then if I can tune, my variable expenses, sometimes there are fixed costs that I cannot control, but if there's variable expenses that I can turn off and make sure that I'm not over-expensing, actually I can pass that restore time also in a very financial efficient way.
Yeah, so now that you've heard the common pitfalls for the self-employed, take a minute to ask yourself, what is your sin? And there's no shame or judgment or blame. So we'd love to get participation from the audience. Thank you guys for staying with us this morning. So we encourage you to put in the chat the number of the sin listed here that resonates with you most. Again, no shame or judgment. Shahar, I'm sure in your years of helping self-employed business owners, you've seen your fair share of financial sins. Any memorable that you want to bring up before
I think if I had to go back, I would definitely focus on the profit first. Building, kind of growing fast business, my focus was always the top of the line. And when you build a business, you also want to think about maybe the day of succession, the day of how you're going to transit and how you're going to exit out of the business. And when business grow, fast, there's some industry that will compensate you for that. The multiplier on the revenue, most industries would also kind of, penalize you for not being profitable. So I think being profitable while you grow, profitability or grow profitable. There is a way how to grow in a profitable way without, getting out of the chart. And I think what keeps me, super excited is the fact that there's so much more to do in the tax management world. When we review tax returns of self-employed, people that are still filing as a Schedule C or a single member LLC, we see this crazy number of $100 billion of self-employed are overpaying in taxes. The $100 billion going into the IRS and the overall government system unconsciously because people falling into filing their taxes as a default. They get no awareness. Again, we're speaking about the awareness, about the recommendation, the action and the impact. People need to be aware that there is other solution than just, filing as a Schedule C or a sole prop. So again, unfortunately, our industry is not dying, but our industry is very old and old-fashioned. We're still using very old tools to assess customer health. And again, and because the world of taxation is geared towards corporations, most of the brains in the world of taxes are serving large corporations, small, medium business, where they can monetize, their knowledge. Again, going back to the scene of selling yourself short, people that understand they have unique knowledge and can add value, will charge top dollar amount. And sometimes, again, it's hard to charge top dollar amount with self-employed. So what we're doing with formations, again, we democratize corporation or we democratize S-corps for self-employed. If you're basically an individual that work for himself, herself, business of one, making, over $80,000, this is the time kind of to think about the next level of your business. Single member LLC is, it's a must as a first step, even if you're not making money. And then the S selection, make your S corporation as your business entity once the business projecting about $80,000 and more. Again, the last couple of years, we analyzed over 500,000 of our customer transactions, ran over 300 million of gross income, the top line gross income. And once we master the expenses, once we master the formations playbook, we were able to save over $24 million in self-employment taxes. Again, we were in a mission, to save 100 billion. So we just started, but, $24 million of our customers' money stayed on their side, helping them to make smart financial decisions, show them what else is possible, invest in their business, in retirement, in benefits, and keep more of that money on their hand. So again, we believe in the S corporation status. This is kind of the new way of doing business when you basically match self-employed with S Corp. Something really magical happened. This is just a simple example. If you're Schedule C, sole prop, making $120,000, probably on top of your state and federal tax, you'll see an ugly line, of self-employment taxes, about $18,000 that will surprise you, because you thought that you're in the 25% tax bracket. Now you're in the 40 because there is an additional 15.3% self-employment tax. But then as an S corporation, see the difference. Again, if you file the S election and you make yourself a small corporation, the savings will be north of $11,000. And again, it's going back into the scenes of profit first, stop for a second and think about short-term goals or long-term goals. Again, my short-term goals, I just want to file my taxes. I want just to get over it. I just want to maybe over-expense. The long-term goal, step back. Maybe I'm ready to become an S corporation. How should I do that? It's a change. I hate changing, but maybe that change is actually worthwhile if I'm saving $11,000, $12,000, $13,000 every year. Again, as a real estate agent, can be another sale of a property without moving from your chair. And if you're a freelance, if you're a graphic designer, if you are, insurance agent, if you're a traveling nurse, think about, that extra $15,000. If you're on average $250 an hour, how many more free hours you get just by optimizing your tax savings? So again, simple example, I'm making $120,000 in income. I'm basically bifurcating my income between reasonable compensation and distribution, tax savings over $11,000. And by the way, again, as Amanda mentioned, before, use the QR code in our slides to schedule some free consultation with our team. We'll augment your taxes. We'll show you, areas in your tax return that you can actually should focus and improve. Because again, this is real. We've been in business. I've been in business, for 20 years, but Formations is a COVID baby. So we went out of stealth in March of 2020. And for the last 3 years, again, this is real numbers from our customers. Again, an average customer that makes between, $100,000 to $200,000 of income, save with Formations over $11,000 in taxes. This is not, change or petty cash. This is a life-changing event by, again, investing in your business, think about the long-term goals, identify areas that you can take more profit, take money out of the business to make sure that the money is working for you. Maybe sometimes leverage, small debt. But again, lean in, use everything, all of the tools available in the box. And Amanda that I have a sentence that is, unfortunately, the IRS doesn't have a marketing department. They cannot be in front of you with marketing tools and advertising. They're using us, tax consultant to share with you the news. This is kind of the news that in 2023, you have infinity amount of tools that can help you to keep more money in your pocket. Before we're jumping into some questions, top of the hour, 6 steps to think about what do you expect if you join Formations, or by the way, if you join, any other accountant. If you're doing things on your own, delegate, pick your dream team. If you have an account that is not moving at the same speed of light that you're moving with your business, search for the dream team people that will actually can give you an advice, can give you a recommendation. They should make you aware of concepts that are available for you, give you the recommendation, not options. They need to let you know what you need to do. You need to do X. And again, make sure that you take the action to see the impact. So again, start with business assessment and cleanup. Make sure that someone specialized in taxes or in accounting review your business operation and just give you, an idea if you are clean and compliant and if you're optimized. If you're not, again, make sure to set a tax optimized structure and definitely separate your business from your personal. So again, tax optimized structure, maybe an S Corp, maybe a C Corp, maybe I don't know, PA, maybe, just an LLC, because you're not there yet from tax perspective. But regardless, separate your business and financials from your personal. No commingling. In 2023, both the state and the IRS will go after those expenses that are not business. Automate bookkeeping, accounting, and payroll, cloud accounting, cloud computing, embedded. It's a new word kind of in the world. Embedded taxes, embedded payroll, embedded banking, banking as a service. If your banking online present is not up to the kind of your expectation, switch to neobanks or banks that has great online presence and have great connectivity to accounting and tax and payroll software. There's so much automated that can build at the back end and classifying the expenses and running your payroll. And again, think about it. As a W-2 employee, all of your friends that working for Microsoft, Amazon, Google of the world, or actually for startup or small business, again, they don't need to deal with their back office. Their employer is basically setting them up for success so they can focus on the front of what they're doing. This is what we are democratizing for the self-employed, ongoing tax management and insight, because taxes, the largest unmanaged expense of every individual in the US. When you add your state tax and sales tax and federal tax and employment tax and property tax and whatever tax, it's way more than your mortgage. It's way more than your kids' education. It's definitely way more than your daily Starbucks. And if you have the idea, or at least the knowledge, this is something that you need to control and manage. Again, there is $11,000, $12,000, $15,000, sometimes $20,000 waiting for you, on the other side. Quarterly updates, really important. Again, getting insight, as we mentioned, around seasonality, when it's time to train, when it's time to perform, when it's time to get restored, and of course, annual prep and filing. This is what Formations will do for you, including, again, making your payments to the IRS and the state feel like a breeze, like any other utility bill. And this is kind of what we want to make sure that the experience, it's easy to use, and you have someone that takes the position for you, help you to make smart financial decision, tell you what to do. And if you don't want to do it, we will do it for you and we'll show you the impact. Amanda, any final words? And I know
I have some really great questions. I know we only have a couple minutes, but there's some really good questions here. But before we start that, really quick, wanted to remind everyone that we will be sharing the recording of this webinar as well as the link to download our 7 Deadly Sins ebook. So please look for that in your emails later today. So Shahar, this question, I love this question, and I'm gonna kind of combine a couple I've seen here. Is there an ideal gross income, or should you be looking at net income that would trigger you when it would be most beneficial to convert to an S Corp? So when does it make sense? What would be a good number, either gross income or net income after expenses?
So the short answer is about $80,000. When you're making $80,000, and can be gross or net, just because, again, some occupation, the freelance consultant or the graphic designer or the marketing consultant or the sometimes the life insurance, agent, they have very little expenses, which means the difference between the gross income to the laptop or, some tools that are using CRM can be kind of very similar. So $80,000, it's kind of the rule of thumb. When I started my business, I had zero revenue. I was heading into my first tax season, and I started as an S Corp because I was confident enough that by the end of the year, I will hit that goal. And in my first year in business, I hit, I think, around $320,000. So while I was waiting maybe to the end of the year to do the S election, I was missing out on ways to expense kind of or mitigate the self-employment tax. So if you're
should
in a
that
full,
80,000 be just my business, or should that be all of my streams of
just your
business?
business. So I would basically separate it from other W-2s, interest, dividends, capital gains, crypto activity, investment activity. If you're a full-time self-employed and you all into perform, restore, training, make smart financial decision for yourself, take your own destiny, create your own reality, start with an S corporation from day one, so you're not missing out on self-employment tax deduction. If you're not quite there, when you have a line of sight for about $80,000, file for the S election. Regardless, from day one, you need to be a single member LLC. Must. Like there is no way in 2023 that people are sole prop and incorporate in their state.
So I know we're at 11 o'clock. If I can ask you one more quick question that you could answer, is how does Formations differ from just having QuickBooks Self-Employed? Like, what are the services that get added to at Formations?
So we are a tax management solution. We're not just a bookkeeping. We are actually a system that will make an awareness. When was the last time that QuickBooks told you something to do or ask you, question about, tax management, retirement, or benefit? So Formations, it's a system that make a lot of awareness in front of our customers around tax management. We will bring concept that you may knew that it's, great for you or didn't even aware. And then once the awareness is there and we know that it's something that it's for you, because we assess your taxes, we assess your financial profile, we will start recommending you things to do, like things that are specifically for you to keep more money in your pocket and to increase your overall financial well-being. And then what we realize that most self-employed are not, taking action on general recommendation. So we want to take the action for you. So we are experiencing a different tax management for our customers, but we are also taking the position. We are replacing, your bookkeeping, your bookkeeper. We're replacing your accountant. We're replacing, the decision makers, the CFO, the COO, while you're sitting in the driving seat, making, still decision as a boss. We are your tax buddy. We are the one that will let you know what's best for you, and we'll take the action and we'll show you, the impact. So this is like a flywheel of success between the awareness and the impact that result in a lot of tax savings.
Yeah, and I think just to add on to that, we have a team of both accountants, tax consultants, and customer success. So you don't have just your one CPA who you're sharing with a lot of clients. You have a whole team of support. But I know we went a little bit over. Thank you all so much for staying with us. I see some really great questions here. I encourage you to schedule a consultation with us so we can assess your specific situation and talk through some of those questions with you.
Great. Amanda, I want to thank you so much.
Thank you.
It went pretty fast. And
I know.
I know the two of us can speak about tax and accounting for hours with each other, with others. Again, it's definitely a topic close to our heart. So I want to thank you first and the entire Formations team to put together this amazing webinar. I want to thank our audience. If you learned something new, let us know, share with us. If you want to hear more from us about specific topics, let us know. Again, super easy for us to be in front of you. I hope that you'll take some of our recommendations and implement it soon, and everybody will have a very, very successful second part of 2023. Good luck, and good to see you all.
Yes, thank you all so much. Have a great rest of your week.